Okay, all right. I think we're going to get started. So welcome, everybody. Really great to have you join us. This is the Accelerator webinar on funding, and it's brought to you by the NatWest, Royal Bank and Ulster Entrepreneurship teams. So clearly, funding is something that is on a lot of people's minds at the moment. The response we've had to this event has been immense, with over 600 people registered for it and over 120 questions submitted by you all to our panelists pre the event. And I can see loads of Q&A being dropped in to us at the moment as well. So there's a lot to talk about. Of course, we won't be able to cover everything on a 2-hour webinar. However, our objective is just to get the discussion going on the current funding landscape, what is available, how have things changed due to the current climate, and what are your best options. And we will also inevitably talk about the future, the funding future post-COVID as well. So it's not a COVID-themed event, but obviously it will pop into our discussion, as everyone can imagine, and it's on everyone's mind. So today is also a key date for business funding, as the Government Future Fund launches today. The scheme will issue convertible loans between 125,000 to 5 million to innovative companies which are facing financing difficulties due to the coronavirus outbreak. We'll hear more about that later on from our panel as well. So I will be your host today. Hi everyone, my name is Christina. I currently manage the NatWest Accelerator in Brighton. I know that we will have our Accelerator members attending today, but half of you will be guests. So a big welcome and thank you for joining us. The NatWest, Royal Bank and Ulster Accelerator is the UK's largest fully funded programme for businesses, with 12 hubs across the UK and currently functioning as a digital proposition, of course. I will share more details about this towards the end of the webinar if you're interested as well. But let's get straight into why we're here. So funding. So we're going to kick off with some introductions from our speakers, and then we will get the discussion flowing with some selected pre-submitted questions from you. And after this, as long as time permits, we will open up for those live questions. So please feel free to submit these as we go. I can see a lot of them popping in already. And what we'll do is we will pick up as many as possible at the end. So if you haven't noticed it already, there is a Q&A button somewhere on your screen. So it might be at the bottom, or you might have to click some dots or a menu if you're on your phone. This will allow you to ask your question, which we will answer hopefully live at the end if time permits. And just an important disclaimer, so the contents of this webinar don't purport to provide any financial, investment or professional advice, and nothing in this webinar shall be deemed to constitute the offer or provision of financial investment or other professional advice in any way. In particular, you should obtain advice from a qualified financial advisor before making any investment decision. Okay, so what we're going to do now is we're going to kick off with our intros. So each of our speakers will share a little bit about themselves and their business and how they fit into the funding landscape of today. Okay, so I think we will kick off with Richard. Is that okay? Great.
Hey, good morning, everybody. Absolutely fantastic. 459 people on the call right now. 460, wow. Great that we're all here, and huge thanks to NatWest, RBS, Ulster Bank for bringing together everybody in such an amazing event to talk about such an important theme. My name is Richard Blakesley. I'm the founder and CEO of Capital Pilot. We are the investability rating agency for startups and scale-ups. And what that means is that we've devised a means to measure in a quantitative fashion how investable a business is, in the same way as Equifax or Experian might come up with a credit score for you. And again, like Equifax or Experian, we'll give you guides not only as to what your score is, but also about how you might be able to improve your score. So our proposition is that companies come to us, they get rated, they get a big report, which gives them all sorts of analysis and suggestions about how they can improve in order to help in this fundraising journey. And it's critically important because actually, with due respect to Ollie, who will have his own fair chance to talk in a little while, funding at early stage is a cottage industry. And particularly right now, what we need is a highly automated production line. And we won't get there unless we can bring scale to the processes of selection and investment decisioning. And that's why we've built this assessment tool and this rating tool to sit at the heart of the funding landscape as we hope, as we foresee it going forward, and particularly at the early stages. Those early stages where companies don't necessarily have the right connections, who might not be based in the optimal part of the country or from the optimal backgrounds in order to achieve the best outcomes for their startup, and who may not know from the get-go exactly how to go about fundraising. So this session today, from my perspective, is all about trying to impart a little bit of knowledge about why fundraising is or is not important for your business, because it's not for everybody. And frankly, right now, probably, if you can avoid going through a fundraising process, probably not a bad idea. It is phenomenally difficult. But at the same time, when we talk about this cottage industry versus production line concept, there's some fantastic evidence in the marketplace today as a result of the work that many people on this call have been putting in as to how quickly funding can be deployed if we put our minds to it. So the enormous amount of work that NatWest and other banks have done around the CBILS, the enormous number of propositions that British Business Bank has brought to market, and the efforts that all people in this industry have been putting themselves to bring assistance to companies that need that help, is fantastic, and a demonstration perhaps of what the future might hold for the funding industry if we can start to move from cottage industry to a more automated future. Now, our own view about how we can help in the middle of this crisis is the launching of our Rescue Equity Fund. And the Rescue Equity Fund, not yet launched, we're raising money for it now, and this is not, as Christina said, an investment advert, but we're raising a fund which will invest £50,000 in early stage businesses, subject purely to the rating that we deliver to that company. So if a company reaches a certain rating threshold, it will receive £50,000. And that's meant to be highly automated, very rapid deployed, and highly scaled, so that we can send investment monies to thousands of businesses across the UK, whether they are in the further reaches of the UK or whether they're in the hotspots of the southeast. Very important for us that we build diversity and diversification into the portfolio that fund will create. Diversity, diversification, two different things, but very closely linked. So that is our view of how we can support the early stage marketplace. Now, I'm talking about early stage equity. I'm talking about those companies that need third-party funding to build their businesses. That's not for everybody, as I said, but there are many other forms of funding which we'll be talking about, I'm sure, during the course of this panel. And one of the key things that we're hoping to be able to achieve is to signal people to the right form of funding, whatever sort of a company they are at whatever stage. So that's an introduction from me, and a little introduction to Capital Pilot. Christina, back to you.
Brilliant, thank you, Richard. And I think your perspective on a lot of the questions that have come through is going to be really interesting to get that kind of different perspective around the matchmaking and how people are assessed for investment. Thank you. Next up, can we go to Ian from British Business Bank? Can you give us a little bit of an intro from yourself?
Yeah, sure. Good morning, everybody. Like Richard said, it's great to be involved today, and thanks for organising to the NatWest RBS team. So I'm Ian Mitchell-Moore, British Business Bank. My day job is to represent the bank's interests in Scotland. So I know the RBS guys up here pretty well. My day job has been slightly suspended for the past 7-8 weeks, in that what we've been focusing on is the new schemes that the government have been launching. So the government's launched 4 new finance initiatives in 7 weeks. That is absolutely unprecedented. We use that word a lot these days, but it is quite incredible to launch that in that time frame, and to actually be delivering substantial amounts of finance in that time frame as well is quite something. So these schemes normally take months, if not years, to put in place, and we've had to do it in a matter of weeks, and in some cases days. The BBL scheme, which is kind of, I use the kind of term flying off the shelves, literally was put together in a week. So more of that later, but What we normally concentrate on is supplying finance of different types to different types of companies. That's everything from early stage equity through to kind of long-term, quite high value kind of debt programs. So we're covering all the kind of different bases, if you like, from a kind of funding perspective. So we do everything through partners. We don't fund directly. We've got about 130 partners in the UK right now, and that's growing every day as we accredit new lenders into the kind of CBILS and BBILS world. But normally we'd be kind of working with a partner to deliver either angel co-investment funding, VC funding, debt funding, taking all different shapes and forms, straight from asset finance, invoice financing, venture debt, long-term straightforward senior debt. So really covering all the kind of options. We're kind of hoping to get back to that at some point, and at some point in the not too distant future, as the government schemes get launched, settle down, and become kind of part of the kind of daily part of our kind of COVID hit lives at the moment. So I think I'll be talking a wee bit more about the Future Fund later on. It's launched today, already getting serious amounts of inquiries through our mailbox. I think it launched at 9. By the time I came on this call, we had over 70 applications in, so that's running at a very high level already. But I say more of that later. I'm delighted to be part of today's call.
Brilliant. Thank you so much, Ian. And over to Gemma from Business Growth Fund.
Good morning, everyone. My name is Gemma Hamilton, and thanks for everyone joining this today. I work at a company called BGF, Business Growth Fund. And basically, we are a simple way to think about it, we're a £2.5 billion fund that invests in growing SMEs across the UK and Ireland. So we're actually the most active investor in the UK and Ireland. And I should explain, our shareholders are the main banks, including NatWest, RBS and Ulster. So to date, we have backed about 300 companies across the UK and Ireland and invested 2 billion. To give people a bit of context, where we sit in the kind of funding landscape, you've got kind of startup earlier stage investors here, and then you've got your kind of large capital markets up at the top end. Where BGF sort of fits in, we kind of typically invest with companies with a turnover of 4 or 5 million revenues, right up to 100 million revenues. So we don't really operate in the startup kind of funding area. However, we have backed a lot of earlier stage companies that have been tracking on that £1 million revenues or run rate revenues of £1 million. So we very much are keeping an eye out for kind of growing companies that are going through that initial fundraising and then, you know, take on some funding, whether it's from investors around the table here today or a mixture of family money as well, family and friends. We see a lot of that as well. And then we like to come in at a later stage and co-invest, whether, as I say, with existing founders or with other investors. So hopefully that gives people a bit of context as to where we invest. As I say, we've invested in 300 companies now, and we will look at all sectors. So we've backed retail, hospitality, manufacturing, waste, IT, you name it. So to give a couple of examples that I'm hoping some people will recognise, a couple of years ago we backed a company called Chunky. Everyone will sort of recognise the children's suitcases you see. We've backed Joe and Seth's popcorn.
I think, sorry, Gemma, you've frozen there for a second, but I'm sure you'll be back shortly. So let's just give it 1 second. So I think Gemma was closing off anyway, so I'll kind of wrap up for her. But if you're interested in some of the other companies, they have invested in some really, really cool early stage startups. So okay, hopefully Gemma will be back with us shortly. So have a look on their website. They've got some really cool websites. They've got some really great businesses that they've invested in. So I'm just going to put Gemma on mute for a second. Okay. Okay, what we're going to do now is we're just going to move on to our next speaker, which is Daniel. So Daniel, over to you from NatWest.
Good morning, everybody, and just share the sentiment so far. A fantastic opportunity to definitely discuss the funding landscape and how it's evolved moving forward. So I'm one of the directors of business banking for NatWest Group. Synonymous with kind of 3 main brands. So you think about NatWest Bank, think about RBS Bank, and you also think about Ulster Bank. But then also what sits behind that are some of these household names such as Lombard from a financing perspective, recently ESME from an innovation perspective, and things like free agent and till, and lots of opportunities for us to be able to help and support customers moving forward. I think for me, we talk about unprecedented times. It's really important that we reiterate that this is not a banking crisis. This is a health or public health crisis that's had a significant impact in terms of the economy moving forward. And there's a variety of ways that I believe as an organisation that we can both support the startup space, the scale-up space, and then that stay ahead space moving forward. And that drives to the very heart of our purpose, where we want to champion potential moving forward. I think there's three main elements in terms of the way that we're supporting customers at the moment. And, Richard and Ian and Gemma have already alluded to the pace, and we can work more quickly, but the pace that everyone is working at to make sure that we deal with customers' most urgent needs. So to give you a flavour, at the moment, we look after between 1 in 4 and 1 in 5 businesses across the UK. We define a business as, turnover from pre-startup to anything up to, a couple of £1 billion. It's really broad in terms of that opportunity. What we've done is supported through 5 billion funds made available. The first 48 hours of B bills going live, we had 60,000 applications, which is just absolutely phenomenal, far more than anyone expected. We've supported 44,000 customers with capital repayment holidays. So these are customers with existing facilities with us that wanted a bit of a payment break, and that help and support to bridge the gap. And then we've also granted around 15,000 temporary emergency facilities on the back of COVID and COVID-19. I think when we talk about supporting customers as we move forward at pace is around that advice and expertise. So we've ran a number of sessions, and this is in partnership with part of entrepreneurship on risk and fraud. We've got a dedicated mentor function, which is around health and safety and employment law. So some of those challenges that individuals might have from a staffing perspective, how can people return back to work? And we've also seen the launch of dedicated hubs on our internet page, which has had over 1 million views. And that's complemented by some of the great work that the entrepreneurship or Accelerator hubs are undertaking to connect with you guys with 12 digital hubs currently across the country. And then the final bit is around that supporting the communities element. So significant amount of work happening in that space. We're working quite closely with the Prince's Trust. So we've made available £5 million worth of grants to support startups or people with ideas and concepts. We've got the social and community grants that are available to help and support. And we've also pivoted a number of individuals across our organisation to be really focused at the front line. So, there's always more to do. Really interested in terms of some of the other panel members and the questions that are going to come in as to how we can help and support moving forward. But I definitely think there's a massive opportunity here for us to think about, what does the next 3 months, 6 months and beyond look like for our businesses and entrepreneurs, and where do we fit in, not only from a funding perspective, but with a joined up approach. What are those other considerations that will allow us to adopt some of that automation that we've talked about, simplify processes, but with a bit of a COVID lens, and thinking about your customers that you were thinking about a month ago, 2 months ago, 3 months ago, what do their transaction patterns look like moving forward? So I imagine they would have changed quite significantly. We'll talk a bit more later about some of the schemes that are available in detail. I think it's important to dispel any myths that are out there on some of the schemes and some of the challenges that people have had. But absolutely in partnership with what everyone has shared so far, this is very much a joined up approach. This is about working collectively as a number of sectors, a number of industries to drive the right outcomes for everybody so we can get through this crisis, that ultimately when we get to the other end, I think there'll be a number of reasons for us to be proud of.
That's great. Thank you so much, Daniel. Okay, we'll go over to Ollie from Fuel Ventures next.
Guys, thanks very much. Can you hear me okay?
Yes.
Lovely. Okay, great. So I'm Ollie. I'm an associate at Fuel Ventures. Fuel Ventures sits very much more at the traditional end of venture capital. We're a seed stage VC based in London. We are an EIS fund, so we are not geographically constricted to London. We can invest into any business within the UK that is EIS qualifying. And likewise, we can invest into businesses that are outside of the UK or predominantly outside the UK that are also EIS qualifying because they have significant enough presence in the UK to be so. We come into a company's life cycle generally at a very early stage, earlier than someone like the Business Growth Fund, for example. Generally, we would be writing tickets of anywhere between £500,000 and £1.5 million. We would be, as part of that investment, we would always be the lead investor, and predominantly we would be the largest investor within the company at that stage. We are a growing portfolio. We've currently got 35 companies as part of our portfolio. We've been investing since early 2016. Our first investment was a company called Motif. And since then, we've built out 5 separate portfolios of investments, and each of those portfolios will have somewhere between 7 and 15 companies as part of that investment, part of that portfolio. Generally, we're very active. We make about 10 investments a year. And again, that's predominantly because we are, as I said, a seed fund. So diversifying that fund is very, very important. And so we make more investments than you would find, for example, at a Series A or Series B investor. And really our role is to be very actively involved with those companies. So we'll always take board representation, and we will always be very actively involved with the company, especially for the first 12 to 18 months. Generally, our first goal is to take that company from the seed round that we've invested in and support them to grow to significantly enough to be suitable to raise a Series A. Beyond that point, we are still very happy to be involved with the company. Generally, we are, but at that point, there may be other investors that are on board as well. Generally, it would be the lead from the Series A that are maybe more actively involved than we are. Yeah, I guess that's us in a nutshell. I think just to sort of summarize what we would invest in as well, we base our investment remit on monetization models mainly, or UX models. So our official investment remit is we'll invest into platforms, marketplaces and SaaS model businesses, both B2B and B2C, which when you start picking it apart is incredibly broad. We could invest in anything from consumer fintech all the way through to deep tech and AI. Sector-wise, we don't have that kind of restriction. We're pretty agnostic, and we can invest in gaming, we can invest in e-commerce, we can invest in consumer finance, anything really. The only areas where we may restrict ourselves is for is one, hardware. We don't invest into hardware businesses, and 2, we don't invest into medtech, biotech, or pharmaceutical businesses, and that's mainly because the level of cash requirement and also the level of specialization is incredibly high. The bar to that is incredibly high, so they're not areas where we think we can predominantly add good value. We were started by a guy called Mark Pearson. Mark was the founder of a company called My Voucher Codes, which exited in 2014. He actually never raised any external finance for that business, never took VC money, never took angel money. He was 100% shareholder of that business. He sold that for about 55 million back in 2014. So made a pretty penny from it. And prior to that exit, he was also a very active angel investor. So invested into some of the UK's fastest growing companies, companies like Paddle, which is a UK-based software business, and Last Minute Tickets. Being a very active angel investor, once Mark had been able to exit My Voucher Codes, he decided to turn towards investing as a bit of a passion project, and that's where Fuel Ventures was born. Mark still makes up at least 10% of all the funds that we deploy. We are a single GP fund, and we raise predominantly the rest of our money at the moment from ultra high net worth individuals and institutional family offices, things like that, generally on the smaller end. So that's us really. I guess if you've got any questions regarding venture capital, if you've got any questions regarding angel investment, if you've got any general questions regarding the seed investment environment, my background is I spent 3.5 years as the senior analyst at a platform called Syndicate Room, which was one of the largest investment platforms in the UK at the time. So I know quite a breadth of knowledge about the very early stage funding landscape. So any questions about that, I'd be happy to answer. Yeah, cheers, Christina. I think that covers most of what I've got.
Brilliant, thanks, Ollie. And absolutely, we have plenty of those kind of questions coming your way. And I didn't know that story about the founder of Fuel Ventures, so that's really interesting.
Yeah, he's done all right. Yeah, he's done okay.
Great. And last but not least, we'll go over to Suzanne from Moralitas. Over to you, Suzanne.
Thank you very much. Good morning, everybody. Really great to join you. Thank you for the invitation. So I represent Moralitas. We're an outsourcing company. We write grant funding applications for innovation, public sector bids and tenders. That's not a snappy thing to explain at a dinner party, but it's really interesting. We get to meet lots of entrepreneurs and innovators with new groundbreaking ideas. That's really interesting. We're based in sunny Rutland in the East Midlands, but actually we have clients right across Europe. We're an international company on that basis, and we're really passionate about supporting small businesses and helping them to thrive. The grant funding landscape for innovation is fairly straightforward, actually. So I'm going to talk you through the main sources of funding. It's the free money you all want to know about, right? So if your company is UK based with a UK market, the first place to go to is Innovate UK. Now, Innovate UK is the company that administers the government grant funding for the commercialization of innovation. That's a mouthful, but basically, if you have a project, an idea that is disruptive, is the in words, disruptive to your industry, groundbreaking, then there is potentially grant funding available to you through Innovate UK. There's lots of useful information on their website, so I'm not going to go on about lots of detail, but fundamentally, during the year, there will be different pots of money for various sectors. For example, there might be funding available for a project with an environmental impact, or biomedical science impact, or women in innovation. And alongside that, during the year, they run a number of open calls, normally 4 during the year, and that's called the SMART grant. You may have heard of it. There's lots of information about criteria for the SMART grant on their webpage, but I should probably explain that the funding available is up to 70% of your project. So you need to have that 30%, and some of that can be man hours, but also you need to be able to cash flow that grant funding, so they'll reimburse you against expenses going out. And now, alongside that, usually on a regional basis, there's quite a lot of grant funding for specific sectors, for various stages of development. I can't talk you through all of those right now. The go-to place for that would probably be your LEP, your local enterprise partnership. And my big key thing to say to you is to check eligibility. That's where a lot of people fall down. You have to be eligible to all their criteria to be able to win funding from them. So that's the first thing to check. Alongside that, if you have a European flavour to your project or your idea, or you think that your marketplace is pan-Europe, if you have partners in Europe, you might have manufacturers in a European company, then there's a similar pot to Innovate UK in the EC called Horizon 2020. So that is on a similar basis, explain the technology of your innovation to be disruptive, and to demonstrate the commercial impact that your project could have. So there's a number of pots of funding within the EC, within Horizon 2020. And I have quite a lot of information on those if anybody wants to come back to me with questions today, or indeed afterwards. I think Christina's going to let you have contact details, or you may already have them. So please feel free to come back to me on any of those. So what do you need to do? What does a winning application look like? I'm going to give you very briefly 5 aspects to being able to apply for grant and win grant funding. It needs to have a compelling storyline. So there needs to be an explanation of why your idea has a commercial impact. It may be creation of jobs, it may be profit, return on investment, but it needs to have a story. The evaluators of these grants sit and read loads of dozens and dozens of these, so you need to be able to grab their attention. You need to be able to articulate the benefits and the impact of your proposal. You need to understand your marketplace and be able to demonstrate that you understand that you found a niche, you found a gap in the market, and that your project is going to fill that gap, breach that gap. Number 3, you need to have an excellent management team, and a lot of the validity of your proposal will rest on the people and the experience and the professionalism of the people on your team. You can bring people in as partners or subcontractors to bolster your team if you're lacking in any area, that's fine, and that adds to your application. It needs to have very clear innovation, and part of the technical writing that we do, these proposals can run from 20 to 60 pages of fairly meaty technical information. So you need to be able to very clearly articulate what is groundbreaking, what is different about your project. And the 5th one I would just flag again, which I mentioned earlier, is you need to speak to the funding body's priorities. So again, it's about meeting criteria, meeting eligibility. These applications, these calls are very competitive. The latest figures I have for Innovate UK Smart Grant success is between 8 and 12% of applications get funded. You are allowed to resubmit for several calls during the year. But at Moralitas, our success rate in the last 12 months is 50%. So I'll leave you with that and feel free to come back to me. Thank you.
Love that, Suzanne. Thank you so much. So much value being dropped there already. Love the 5 key things. That's great. Okay. I mean, first of all, how awesome is it that we've got all these different people from different areas of funding all in one place together to answer the burning questions. I'm really excited to get started with those. So like I said, there was over 120 questions submitted, loads of really, there was a lot of common themes, which we've picked out. And there was a lot of very interesting specific questions and some very creative ones where people actually pitched for funding. So I thought that was very amusing. I love that. Nice one, guys. Shows a lot of ambition there. But one question really stood out to me, which was very simple. And it was just a surprise question, which was, are people actually still investing at the moment? Which is a really interesting point to raise, because, you know, there was a point where everybody went through a period of shock, right? Everything halted. People, you know, entrepreneurs were telling me that their investments had paused and they weren't able to access funding. So I guess that question is a really great place to start. Are people investing at the moment, and have their priorities changed at this point? It would be great to start with you, Ollie, if you can kick us off with your perspective on that.
Yeah, no problem. Okay, great. So the short answer to that question is yes, people are still investing. We at Fuel are still investing, and we're still interested in seeing new opportunities that we can look at. But the reality is that it's very dependent on who you are targeting. Because of current circumstances and because of the current situation, people are becoming a little bit more hesitant with their cash. Now, when you're talking about angel investors are very, very different from, say, VC investors. Angel investors do not have the same incentive as VC investors to get the money out the door, as it were. So angel investors can sit on their cash. They can sit on their cash and they can retain that wealth, and they can put that wealth into other places. So actually, angel investors, I can see why at the moment some of them are slightly more hesitant in parting with their cash, especially for early stage companies where the risk profile is higher. When it comes to institutional money, VC investors like myself, actually there's only so long that we can sit on capital. Like I said, we're still very actively investing. We think there's good opportunity in this market. There are some companies in our portfolio that are doing extremely well. In the current situation, our portfolio is almost exclusively digital. So the whole working from home aspect and the whole everyone else working from home aspect isn't necessarily too much of a limiting factor. And so we've got some companies that are doing very well. We do have some companies that are struggling, but we're working quite closely with those companies to try and help them there. But the reality is that as a VC fund, we are given a pot of money from our LPs, our limited partners, our investors, which carries the expectation of an investment portfolio into early stage companies. So there's only a single remit that we can follow. We can't take that pot of money and put it into other asset classes because we're restricted to investing into early stage companies. So to an extent, even if for the next, or I guess for the previous month or 2 months, VCs have been sitting on their hands a little bit, seeing where the chips fall. To an extent, we can only sit on our hands for so long, because we need to allocate that capital. We need to come to decisions. We need to be able to see, right, we've sat on this money for a month or 2 months now, just to see how the market's developing. How is the market developing? Where are the opportunities in this market? So I would say that people are still investing. I have seen angels actively invest as well, but it is highly dependent on who you're targeting. I think angels are going to be much more hesitant to part with their cash at the moment. And that's purely because angels have other options. It's personal wealth. They can go into different asset classes. Liquidity is an issue at the moment, especially in things like the property market and capital markets, because of the sort of the downfall of capital markets at the moment. Yeah, it really depends on the demographic, but are we as fuel? Yes, we are actively investing. We are actively looking at new opportunities.
Right, and just to add on to that, Gemma, how has BGF reacted from your perspective?
Yeah, I was going to say similar to Ollie, we are very much. Sorry, I'll go off video to make sure you can still hear me. We are very much still open for business, and we are actively investing. So I've seen things go to our investment committee. I think, just being honest, it's going to be a bit challenging over the next 6 months. I think you'll find some investors will slow down, and you can understand why, because they want to know what does the new world look like. But to Ollie's point, and I think we touched on this later, there is still money out there. There's a lot of capital in addition to all the kind of government funding and grants that we're getting. And if anything, I think after the 6 months where the banks have been providing their CBIL loans, we've got grant funding, the Future Fund, then there'll be another kind of gap where companies go, right, I really want to continue growing. And then there'll be that sort of spate of another period of growth required, another period of funding required. So I'm kind of relatively optimistic post the next 6 months. But from our perspective, yes, we are very much investing. We are probably saying, okay, what sectors are there that are going to perform well? And Ollie sort of raised this probably more on the sort of tech side. And if anything, I think we've realised having an online presence is really accelerated. We have some online operators that are doing very well. For those that are just getting into it, they've realised really need to be on top of this because the new world is going to be so important.
I don't know if it's worth me quickly diving into, because I agree with everything that Gemma just said. Just to follow up on a point that Gemma made about looking into certain sectors, I'm totally on board with that, and I think she's completely right. From our point of view at the moment, there's a couple of sectors that we are struggling with in terms for an investment proposal. The main one for us at the moment is the travel tech sector. The travel tech sector is something that we are very interested in, and it is a space that we see significant opportunity, probably significant opportunity within the next 6 months. The problem that we've got at the moment is that we just don't know where the chips are going to fall. The reality is that the travel sector is propped up by a bunch of very capital intensive companies, which are the airlines. And we just don't know how the airlines are going to react and how they're going to survive through this crisis. We've met a couple of really interesting travel tech businesses whose key partners are major airlines and major holiday makers, all of which have now come out into the public and said that they're struggling. So even though that when we looked at those partners originally, we thought, well, these are some great partners. Actually, now we don't know if those partners are still going to be there in 3 or 4 months' time. So that's a place where we see opportunity, but aren't necessarily actively investing at the moment. On the other hand, we as Fuel have always been very bullish about the idea of professional marketplaces. And professional distributed marketplaces. So we've got a couple of companies within our portfolio now, CG Hero, Distributed, and a couple of new ones, which I can't really reveal at the moment, but they will be revealed hopefully in the next couple of weeks, who thrive off the idea of these distributed professional marketplaces. So people from all around the world collaborating on specialist roles and specialist jobs. And we're very bullish about that space as well. So there are spaces we're much more bullish about at the moment than others, and those are probably the spaces that we're going to look at more closely.
That's really, really interesting to know. I've got some proposals to connect you with then. Ollie. Cool. Okay. On that note around, you know, what's happening with investment at the moment and what the priorities are for investors, I think we need to talk about the future fund, right? Because with it launching today, everybody's got there's a lot of questions that came through actually about the future fund. So Ian, it would be great just to hear from you around, you know, who is it aimed at? Who can access it? Because I know there's been some questions around, obviously the criteria is quite strict in terms of turnover or investment raised previously. So can you tell us a little bit more about that and how it links into sort of helping the economy thrive going forward?
Yeah, sure. So, I mean, it is really aimed at companies who have already been kind of fundraising. So one of the key criteria is that a company must have raised a minimum of £250,000 in the last 5 years. And as a subplot to that, the company has to be incorporated prior to December 2019. So it is trying to kind of look at kind of very early stage companies and also kind of companies who've been around a bit longer. It's match funding, so you know there has to be a kind of a private investor who's leading the investment round, and we see this very much as an investor-led program. So we don't see companies themselves coming to us directly. So we're targeting the kind of investors to come to us and tell us they're prepared to put money in, and we can then look at kind of match funding that. I mean, it's very much geared around the kind of key sectors that are important for us all kind of going forward. So it's like technology, science, medtech, things like that. Although we will look at in any sector that needs that support, but these are the sectors who tend to have that kind of fast growth. You know, lots of investment activity over the last few years or so. So they're naturally going to, I think, kind of fit into it. There's some other criteria around it regarding the company itself. It has to have at least half of its employees in the UK. So it's not really designed for, you know, overseas companies who have a kind of small presence in the UK. So we're looking for half of the employment base to be here, and half of any revenues that are generated by the business must be generated in the UK as well. So really kind of trying to focus in on UK-based companies as opposed to kind of overseas investors who've got a kind of bit of a subplot here. The process, I mean, Richard talked about automation. It is pretty automated. So from when you launch your application into our inbox, there clearly will be kind of interaction in terms of discussing, etc. But everything else from there will be kind of generated automatically. The legals, the documentation, all the kind of board minutes, etc. that we expect to see will be generated through the kind of portal. It's up to the company at that point, I think, whether they need to have any kind of specific kind of legal input. There'll be the stuff around the kind of loan note structures, which, you know, I think people are still maybe wrestling with a little bit in terms of the kind of conversion rights, things like that. But it's all pretty well explained in terms of the when you go into our kind of live portal this morning. But yeah, very much designed to try and help any company that has got investment aspirations right now. You know, it's not going to be for the very, very small early stage companies who haven't hit that kind of 250,000 investment raise over the past 5 years. But I think the analysis we did, that there should be quite a few who kind of quite easily kind of fit that kind of bucket. Outside of that, there's not really much I can say without going into kind of huge amounts of technical detail, which I'm not sure today is the day for that. But I'd encourage people who are kind of on that kind of investment journey right now to have a quick look at the kind of application process, which is live now. It's pretty straightforward, and there's a lot of self-certification by the companies as well. So it's not like a normal investment round where you might have, you know, quite a few weeks, months of diligence and external advisors coming in to pull over your books, etc. A lot of it is self-certification by the company, and we have to rely on that. And I guess that's why it's investor-led. So we're relying on the investors to have done as much as they can do in these kind of slightly kind of challenging times to get that information correct. But we're pretty hopeful for it. You know, it's been a wee while in the making. We announced on the 20th of April, so we're a month after announcement to launch. But that's because we wanted to get it right. You know, to have all the kind of technology in place that will hopefully make a smooth process.
Brilliant, thank you, Ian. I guess, yeah, like you said, there's been so many different things that the government have launched, and it's in such a short space of time, and obviously it's about getting it right. And I guess for the businesses, it's figuring out where they fit into on that landscape from government funding, isn't it? I think, Daniel, did you want to?
Yeah, I just wanted to chip in there. I think there's a build on what's been shared so far, that a number of people in business, you know, their focus has been very much around, either depending on where they sit, whether it's the startup scale up or kind of moving forward, that there are a number of schemes available that have been launched by the government, some in partnership with financial institutions, others with investors, and others from government directly. And I think the key here is taking the time, even though everyone's working at pace, to really familiarise yourself with a number of the schemes that are available. So yes, there's grant funding, yes, there's investment funding, yes, there's the conventional funding that we've just talked about, but it's really important that the people attending today's webinar, I think we're up to 490 people, really understand that come to us as an organisation or other organisations with a true reflection of what you think you're going to need or want, rather than what you think you can get away with. And I think having that approach, not only for the urgency of what is required now, but if we fast forward for the next 3 months or 6 months, what does that potentially look like for you? Come to us with that package and proposition, and then with a joined up approach and working with a number of other individuals and a number of other organisations, we then should be able to get to the desired outcome. And I think that's a really important point, where in the past, we probably haven't had that. It's, you know, I need that, I think I can get away with this amount of money. That's what I'll apply for, I've got it. And then a month, 2 months down the line, there's a run out of cash and you have to go through that process again. And that's not what I think anyone on the panel wants. It's kind of, what do we do to make this as slick and seamless as possible to help you, in essence, get through this, but also come out the other end and in essence thrive in due course.
That's such an interesting point, Daniel, because I think a lot of people are thinking about survival at the moment, but at the same time, you need to be thinking about that long term when it comes to funding. So it's such a tough position for a business to be in at this stage. Richard, did you want to add in on that?
Just a quick point. I will make it really quick, promise, which is to tie together the previous two questions. Absolutely clear that there is less appetite right now for investment from equity investors. Taking into account what Ollie and Gemma have said, which is absolutely true, but less appetite right now, less money available for funding. Absolutely clear also for some analysis that we've done over the last few weeks that the various government announced schemes, if applied to this universe of 28,000 companies that Bohurst described as ambitious growth companies, 60% of those companies aren't actually going to get any money from any of the announced schemes, either because they're not eligible or because there's limited amounts of money currently available under those schemes. Now, that's not a criticism, because I think it's amazing what's been done so far and extraordinary how much money has been deployed. But let's just put into context the issue here, which is 60% of businesses probably aren't going to get anything and are therefore reliant upon the private sector, which, by the way, really should be picking up the baton and doing some stuff, self-help, entrepreneurial self-help, to fill some of this gap. We shouldn't be expecting government to fill the entire gap. But there is a big issue there. And so to Daniel's point, yes, absolutely, it'd be wonderful if we can plan long term. But as Christina said, there's a little bit of crisis going on at the moment, and can't wait to get it to that point where we can plan strategically, because we're able to do so.
Yeah, great points. And I think we'll just have to wait and see what happens with that one, or obviously people not waiting and seeing, but taking action more so. So on moving on from that point, but kind of staying on a similar vibe, I think there were a lot of questions around the future, around how what's happened is going to affect the future of the funding landscape. You know, with many businesses now, government or bank funded, who may have never considered that kind of funding previously, but it's been necessary for them now, are they going to become more open to different funding options in the future? You know, and how has the current climate affected people's perspective on the different funding options? And will that affect on the kind of funding options available? I think, Richard, you kind of started touching on that. Back to you, Richard, I guess, you know, what are the key things that you think will change in terms of entrepreneur and investor behaviors based on what's happened?
think there are two conflicting themes going on, because on the one hand, I think entrepreneurialism, startup funding has been a little bit of a bubble, and there's been this kind of well-worn track that has become almost an expectation. You found your company, you get your friends and family money, you go into seed stage and so on and so forth. And that track may just be a little bit blocked now. So it shouldn't be expected. So there's an expectation, I think, now on all entrepreneurs to kind of do it yourself to the extent you possibly can. Focus on revenue, cash flow, weird things like that. Sort yourself out and don't necessarily expect that third-party investors are always going to be there for your business in the very near term. So what can you do to fix your own problem right now? Now, diametrically opposed to that is the fact that there are lots and lots of people who are now having to think entrepreneurially because they are finding themselves suddenly without secure employment. So you've got an upsurge of entrepreneurialism on the one hand through need, and on the other hand, a bit of a bursting of a bubble of, isn't it great to be a tech entrepreneur? And I think they're kind of both quite healthy in a funny sort of way. And looking forward, I think a few things are going to happen that are going to quite fundamentally change the landscape. One is, I think that there needs to be a bit more focus on the fundamental, on the cash flow, on the revenue generation potential of businesses. Second of all, Ollie's already referred to it. There are businesses really just now that are not fundable. Sorry, but just aren't fundable. And that's life. 9 out of 10 businesses in early stage aren't going to make it, unfortunately, anyway. And we can't expect that there's funding available for everybody. So real cold, hard look from an individual's perspective of what is and is not available, as well as foraging around to the extent possible for support of all different kinds, two key themes. But as we move forward, and again, Ollie did refer to this as well, we're going to see a bit of a normalization, although I don't think things are going to come back to anything like where we have been for quite a long time. And I think that relies on a couple of things. First of all, different forms of funding from different sources. And that might include the horror for some early stage businesses of cozying up to big corporates and trying to find people who can support them at an early stage. And I think actually there are some big corporates that are very willing to consider those sorts of options because it's important to their own businesses as well. So corporate funding, direct corporate funding, as well as the build your own revenue story, as well as being very wary in your approaches to forms of third-party funding about the real appetite. And that goes down to checking that you've got a great match with that potential investor and making sure that the proposition that you bring to them is not only fantastically well prepared, but also highly relevant to them and to now.
Great, very great cold hard advice, I think, Richard, earlier. It's very valid points. I think on that note of money, won't always be available. Let's talk a little bit about the grant side. So because of the current economic climate, and obviously the UK has now left the EU, are all these grants for SMEs now a thing of the past? I don't know, Ian or Suzanne, if you'd like to touch on that.
Yeah, I'm happy to comment, thank you. For Innovate UK, I would say it's almost business as usual. The date of the last Smart Grant deadline has been pushed back. So we're currently in the extended period, the deadline's next week. But generally, the Innovate UK, the government funding for innovation specifically, is pretty much business as usual, to be honest. What we're finding with our clients is they're in two camps: those who are just super busy, homeschooling, struggling to manage with the work, and their projects possibly on the back burner or just been put on the shelf short term. And then there are other people who have got more space at home and in their work situation, and actually it's a really good time to develop your innovation projects. Potentially the next couple of calls will be a bit quieter, so the chance of success may be higher. For the EC funding, the Horizon 2020, if I could just explain briefly, this was a 7-year programme that concludes this year. Obviously the impact of Brexit's big question. What the government have said is that if the EC create a new funding opportunity, which they have done the past 4 or 5 times, this has been rolled over, then there are non-EU countries who can apply to that fund. So Norway, for example, have been successful in applying for grant funding from the EU. So Britain may be able to do that. Alternatively, the government will then create a fund alongside if we can't be part of that, and that will be announced later this year. So from my side, from innovation specifically, and yeah, business as usual, and potentially a little window if you've got time to put some focus on your project. Potentially this is a good time to do it, actually.
Yeah, I think from a kind of broader funding landscape, I think it's quite clear that there are going to be pockets of the current activities. I mean, the regional funds, for instance, that are active in the Midlands and the north of England and the southwest have got a bit of European money in them. Now they're fine, they're committed, but we have to find a way to kind of replace those in due course. And as Susanna said, the government has been pretty clear that they will make resources available to kind of fill those gaps. We're also looking at kind of wider regional funding and whether or not it's time for us to kind of put more regional funds out there. Now that will take a bit longer now, given that we've had to kind of pause most of our kind of normal work because of the current kind of problems. But there's certainly no shortage of appetite to make sure that the right sort of funding gets to companies going forward.
As a slight follow-on to that as well, I just want to mention the role of the more recent pickup role of venture debt in the landscape as well. And we are seeing more private companies, and I think what Richard said was right in that we need to expect private companies, private sector to take up some of that slack. We are seeing an increase in the number of private companies that are offering venture debt options. So, for example, we've got one in our portfolio called Just Capital, who offer venture debt options for early stage businesses. The reality is that venture capital, speaking as someone who works in venture capital, should not be the mechanism that underpins startup investment in any country, let alone the UK. Venture capital is an extreme example of what companies can use in order to grow fast. But the reality is that the vast majority of businesses are just not suitable for venture capital. And that's not because they are bad businesses. That's not because the entrepreneurs aren't good enough. It's just because they're not suitable. Reality is that venture capital as an investment strategy is completely reliant on outliers. It's reliant on single large performance to underpin entire portfolios, which means that when I make investment decisions, I need to be making investment decisions based on companies that I think can reach extreme valuations. It means that I need companies that can go from a 3 million pre-money valuation where I might invest to 100 million plus valuation. I don't want a company that doesn't have the opportunity to reach $1 billion in valuation. These are extreme examples of companies. These are not the mainstay of companies that come around in this country or indeed anywhere else in the world. And the reality is that you don't have to run one of those companies to be a very successful entrepreneur or to run a good business. So I do think there is this big chunk of companies out there at the moment who find that venture capital isn't quite suitable for them because in terms of their growth expectations and in terms of their market sizes, they're not operating in large enough spaces. Some of them try and force themselves to operate in a larger space in order to get that position. But they are, within their own right, they do have the potential to be very successful businesses. And I think companies like venture debt companies are probably the ones that are going to come in and take up that slack. They're going to be the ones that fund those businesses that don't see themselves as being multi-billion-pound businesses, but see themselves being valued higher than the average business in the UK, probably a larger risk profile than some businesses in the UK, but don't want to grow to that level where they're running unicorn-style businesses, which is fine. And I think that that's a particularly good option for those who are looking for that opportunity.
Great, thank you, Ollie. And I think leading on from that answer there was a lot of questions from the audience around how do you know what funding option is the right one for your business? So you touched on a lot of that there, and whether you should go for funding at all. And I guess a great way to address this is, from your perspective, what are the questions that an entrepreneur should be asking themselves to figure those things out for themselves, because nobody's going to be able to just tell them that. So what questions should they ask themselves? Whether should they get funding and what kind of funding is right for their business? Richard, could we come to you first?
Sure. I would say, yeah, somebody ought to be able to tell you that. Somebody ought to be able to explain to you what's the right form of funding for your business and what isn't. And there are some fantastic guides out there, by the way, and actually, not to be too cozy with British Business Bank, but they've got some really great resource online about how to identify the right sources of funding. And obviously within NatWest and the RBS and Ulster banks, there's some fantastic collateral as well, and other brands also exist. So I think really worthwhile to research, but we've said the same thing in a couple of different ways, I think, here, which is it's really important to understand really what your expectations as a business are and what the potential for your business is. So I talked a little bit before about that well-worn track for growth businesses and the bubble that's come around entrepreneurialism and early stage tech in the last few years, fueled by the big San Francisco thing. And I think that's questionable now as a way forward. I do think that it's also important to be much clearer as an industry in terms of what is and is not available to you. So debt versus equity is one obvious distinction. To borrow, very typically, and it's slightly different right now with bounce back loans because they've got slightly different criteria from normal market condition lending. You need to have some cash flow. You need to be able to repay a loan. Can you repay a loan? Can you not repay a loan? That's fairly basic for debt. For equity, really, it's about, can you generate investor growth? Is your business going to be worth several times what it's worth today in a few years' time? And does that look like it's attractive to an investor to offset the risk that they're taking in putting their money into your business? Now, even before you've been down those two tracks, you should really be talking to people like Suzanne about all of the grant money and other, if you like, free sources of capital that are available. R&D tax credits, often forgotten, not yet mentioned. And by the way, you can borrow against future R&D tax credits. So as a business which is an R&D intensive business, there's potentially sources of capital there too. So various ways in which you can raise money, even without having to pay for it, or alongside forms of capital that you need to pay for. And again, it's back to research and really scratching around to find regional, as Ian mentioned, the regional funds that exist, even down to the individual local economic partnerships who often have sources of capital available, chambers of commerce and so forth. There are funds, there are various different elements of local support, and there are also plenty of sources of funding, and there's a question about this on the chat, around specialist sector focused or impact focused funding. So for businesses that have a particular social goal, or has a climate or sustainability goal, or to support minorities who are underrepresented in the overall funding landscape. But it's really down to this matrix. Can you get free money? Step one, grants, R&D tax credits. Can you repay a loan? And are you the right sort of company to be raising equity from people you don't know? So it's possible to raise money from people you do know on slightly softer terms. Been there, done that. Sorry, brother and sister. But this is actually, it'll be fine for them in the end. But overall, if you're going to raise equity, you really need to be able to demonstrate to reasonable third-party satisfaction that you're going to make that an investment worthwhile.
Very, all the details are there, I think, Richard. Is there anything else, Gemma, that you could add to that around what questions entrepreneurs should ask themselves?
Yeah, I would even put yourself in the investor's shoes, and if it helps, I can tell you what we look for when we're investing at BGF. So number one, and I'm sure this is probably everyone will agree with this, is the management team. Do we believe in them? Is this a team that's backable? Have they done what they said they were going to do? Do they know their own kind of limits and boundaries? And yes, we want ambitious teams, but we also want them to be realistic and follow through. So when we invest, we're always a minority investor. And without being too blunt, what does that mean? It means that we're always capped at 40%. We do not take control when we invest. So we're very much relying on the management team to really deliver a plan. So we have to have a good working relationship. So a point that sort of Richard has talked about is, You know, you don't want to go and take investment from a complete stranger. You really need to be selective with your investor and build up a relationship and actually go, is this a fund that I can work with, and what else are they going to bring to the table? And then another thing that's probably worth flagging is, as an investor, for us, it's all about investing in the growth opportunity. And Ollie mentioned this: is this business going to be worth 100 million one day? Now, we don't need all our companies to be worth that. It'd be lovely if they all were, but for us, it's, you know, is there a growth plan here? Is the plan built on reasonable and historic assumptions? And then for those earlier stage opportunities where there's not so much of that historical information to rely on, we very much say, okay, what is this as a growing market for a start? And what is it management are doing different to others? Have they got a disruptive model? Why are they winning work? And then we will really hone down on your pipeline and say, okay, if someone presents a plan saying, you know, I'm going to be generating £1 million revenues in a year's time, I'm going to ask, okay, how are you going to do it? And show me how that pipeline is built up. And then we actually get people from the sector that have been there and done it to help us assess, actually, yes, this does make sense. This is a credible plan. And I was going to say, if you can't get that to stack up, I would pause and wait until you are comfortable, because the last thing you want to do is take a plan to an investor that has lots of holes and gaps in it, because that will come down to your credibility of your management team. So I think, again, we've touched on it earlier, is picking the right time to raise funding. And another thing just to sort of flag is, appreciate there might be a lot of people on the call that aren't able to raise bank debt, and then there'll be a point where they are raising debt, but then the banks are only willing to lend to a certain level, which completely understand, and we can't rely on the banks and government to fund everything. So there will be this gap, this equity gap, and I think that is the opportunity for companies out there to say, right, it is time to bring an investor on board, but I need to find the right investor and find the one that works with you.
Brilliant. Thank you, Gemma. That's super valuable advice there. Ollie, is there anything else to add there around the what you should ask yourself when deciding what funding is right?
I think the only thing that I would add is that you need to align yourself with the goal of your investors. So I would say that, especially for a lot of seed venture capital, I appreciate Gemma's situation is a little bit different because of the backers of the fund and the stage that they invest at completely. From our point of view, we are a sort of privately funded VC fund, sort of much more your traditional seed fund model. So it's maybe a little bit different, but I think you need to ask yourself what the goals of your investors are, as well as what the goals of what you're trying to achieve are. We get a lot of people approach us from a venture capital perspective who are, like I said, trying to build great businesses, but are not trying to build great businesses that, from a size and scalability point of view, are VC backable. Just appreciate that when you're talking to a VC investor may look at your plans and say, look, you're looking to make revenues of 10 million in year 5. Well, do you know what? That's great for you, and that's a very valuable business. But really, I need a business that wants to make 100 million revenues in year 5. So our goals are misaligned here, and that's not a problem. You go away and build a great business, and it might be that you take small angel investment. It may be that you look at the other available sources of investment, and you go down that route. So I would say just make sure that you're aligning yourself with the goals of the people that will be investing in you. Goes for debt, what Richard said. If you're looking to raise debt, then generally you're going to have some kind of positive cash flow in order to pay that debt back. If you are that business, if you're looking for a positive cash flow business, then debt's probably your better option. Yeah, that's all I would add on. But I think the advice given so far is great. So I won't add anything else onto that.
The build on there, Christina, and I agree with sentiment so far, definitely by Richard, Ollie, and Gemma, is just around kind of that starting point as to free money. Let's use that term in terms of where eligible. I think really important. I think if we look at kind of the second tier, which is around borrowing and the need to pay back, and kind of dispelling that myth that it's kind of free money, but what will happen in 12 months, you know, thinking about kind of the propositions that exist out there. So I'll talk from a NatWest RBS and Ulster Bank perspective. So, you know, customers that are approaching for facilities between 50,000 and 500,000 and above typically will have a dedicated point of contact at the bank that will be able to talk them through. So this is predominantly that CBIL space, so the Corona Business Interruption Loan space, rather than the bounce back loan scheme. So bounce back loan, very designed to be almost kind of a self-serve or self-certification process. You apply and it kind of works or it doesn't work. But the Corona Business Interruption Loan Scheme, that's where those dedicated points of contact at the bank or at our organisation are able to then add that value and say, right, actually, what you're telling us, has there been a bit of a COVID lens applied? Have you thought about some of these additional considerations? And I think that's a really important point that says, okay, we don't want you to reach out to every man and his dog, as it were, to try and get advice and expertise because you'll overwhelm yourselves, but just have a clear approach in terms of a couple of organisations or a couple of individuals that you may want to apply, you might want to seek a bit of advice or input, and that should then help and shape what your plans are moving forward from a funding perspective.
Great, thank you for that, Daniel. And around, sorry, I thought somebody was speaking, never mind. So loads of value there around what should you be considering. And I wonder, from a grant perspective, Suzanne, is there anything in particular? Obviously, you mentioned around the 5 key points of what to have in place. What about for people? So people who aren't quite ready for lending or for investment, and they're kind of looking at the grant funding landscape first. What stage do they need to be at? Can they be very early stage? Can they be idea stage to look at that?
Thanks, Christina. Good question. So, I mean, I pick up on some of the points that have just been talked about. The grant funding is very similar in that eligibility needs to match. They want to see a return on investment. So it's not charity, it's not a handout, it's to demonstrate a level of commerciality. That funding gap could be, you know, I think people should be looking at the length of time before they start to make money, and look at how that would work for a return on investment. I would particularly say to people to really know their market and know the potential, to do some proper market research, talk to potential customers, see how interesting and what the appetite is for their product, and to be able to give some robust numbers behind what they think they can achieve. You know, it's lovely to have the ambition of turning over 10 million in 2 years, but for grant funding applications and for investment, you know, we would need to see some proper considered robust numbers behind that. Regarding innovation grants specifically, there's a scale called the TRL, the Technology Readiness Level, which I won't bore you with the detail, but it's fundamentally a section in the middle between having a brilliant idea one day when you're wandering around doing whatever it is you do for a living, and you suddenly think, if I could make this, I could change the world. That idea, that's not fundable by grant funding. Equally, if you already have some sales contracts, your prototype's all signed off, it's all ready to go, you have a product to sell, then there's not funding at that end. So there's a stage in the middle, or a series of stages in the middle, where you've got a tested product, but it might not be final, it might need some changes. You understand your market, you've identified the problem in the market, and you have a solution. And I think I talked earlier about having a level of a professional team around you. So if those things are largely in place, there is funding to fill the gaps to get to a place where you're ready to apply for full commercialization. So if anybody's interested, I can go into a lot more detail, but probably not right now. But it's that sort of midpoint, having something developed and tested, but not ready to bring to full commercialization. That's the funding gap that grant funding will look to fill.
That's really helpful, Suzanne. Thinking there are a lot of questions from people around funding a business that's pre-revenue, and you know, of course, things like business growth fund will require revenue at that stage. But I guess grant funding is a really great place to start if you are pre-revenue, right? So I think that answers a lot of those questions. Ollie, sorry, go on. No,
sorry, I would just thank you. If I could just pick up, I mentioned earlier about being able to cash flow and having some funds behind you, and then Richard very helpfully mentioned about R&D tax credits. So if you have spent time and salary in developing a product, then you can apply for tax relief on that. That's free money back from the government. Not everybody knows about it, and it's quite technical to apply for. You need, again, to be able to really specify what it is that you've done that's novel and groundbreaking. but you can apply for tax relief back on money that you've already spent in the last couple of years in developing your project.
Great, thank you. And Ollie, do venture companies like Fuel Ventures consider companies that are pre-revenue, or is that a no-go for you guys?
Generally, I would say that it's not something that we generally look at. The only times that we may look at a company that's pre-revenue is if there is a regulatory barrier that requires funding, which is a key reason why the company is a pre-revenue business. In those instances, we have looked at opportunities, and generally the only way that we would take up those opportunities, or the reason we would take up those opportunities, is if the team came from a significant amount of pedigree, I would say. So if people within those teams had run large businesses before, had significant connections within other businesses. I know Gemma mentioned it very briefly earlier, but team is very, very important, and totally agree with her on that point. It's important in all the investment decisions we make, but when it comes to pre-revenue businesses, to an extent, it becomes one of the more exclusive decisions or one of the exclusive factors that we make a decision on. That alongside expected market growth and current market would be almost exclusively the key factors we would make a decision on.
Great, thank you. And just a question for Ian, or anybody else who I'd like to open it up for. There's been a lot of questions around what funding is available for charities, community interest companies, social enterprises, because they seem to kind of be missed out here, and a lot of them are struggling at the moment. Ian, do you have any thing to share on that one?
Yeah, sure. I mean, some of the companies that you just kind of mentioned have actually approached us under the kind of CBILS arrangements. Now they are a slightly more challenging prospect for us, just in terms of the way they're structured. But we have got, I think, 3 at the moment, which are going through the accreditation process. Can't name names, but you know, it is open for these sort of businesses or organisations. It is more challenging just because of the way that they're structured, and also the kind of historical ability of them to kind of look at and understand credit assessment, things like that. That's quite a key part of the kind of CBILS kind of operations. But some of them are, you know, they are kind of well structured. They've been around for a while, so they will fall into a kind of category where we think we can probably help them at some level. I think from a kind of lower level point of view, the kind of smaller charities and not-for-profit organisations, it is really tough, and I think the schemes that have been announced so far probably don't really kind of fit the bill for most of them. The Chancellor did announce a block of funding for charities. I can't remember the exact amount, but I think the view was it wasn't kind of big enough. Like all these things, you know, these things have been flexed and changed over the past few weeks. We've seen amendments to all the schemes in some shape or form, whether it's in scale, whether it's in some of the criteria. So I suspect that kind of charity element will be looked at again. So I think it's been used up pretty quickly. It is a challenging area to get commercial funding put into. So it really does kind of rely on kind of soft funding. And the grant kind of regime probably doesn't again cover everything there. But the government has announced a fairly large chunk of money to go straight into charities.
Thank you, Ian. So kind of to wrap up, we kind of gone into loads of different tangents there around funding options for businesses, but I think it's clear that there are so many different options available, and you just kind of have to do your research. But and also from the entrepreneur side, you know, having worked with hundreds of entrepreneurs for our accelerators, I think it's really important to also have a think about what kind of business you want to run, right? So a lot of the statements that the panelists have made around what investors look for, you have to be aligned with that. So what kind of business do you want to run? Do you want to run a huge scaling business? And how big do you want it to grow? Do you want to have an exit strategy, or do you want it to remain yours? So I think all of that kind of stuff comes down to, you know, your own entrepreneurial ambitions. What do you want to do is probably the first question to precede all of the others as well. So another question that we've had was specifically around innovative business ideas, because obviously there's the fund for innovative businesses, and then there's grants for innovation, and then investors investing in innovative ideas. So a question somebody had was, how do investors or funders audit or validate technical, innovative ideas? Do they seek external consultation? How does that process actually work? Because I presume a lot of the funders won't have all of those experts in their team. So really interesting question to consider. Ian, do you have a perspective there for the Future Fund side of things?
Yeah, I mean, I think the Future Fund is clearly kind of focused on what we would generally class as innovative companies. There's no question. As I said earlier, that it's open to anybody to apply for. I think the key kind of areas are kind of innovation, tech. They tend to be the kind of companies that have already attracted some form of investment. I guess that's why we've kind of gone down that route. I see there's a lot of questions flying around about EIS, etc., and angel investment. Can I just talk about that briefly?
Of course, yeah.
I was looking at trying to answer some of them, but there's too many to answer. There's a kind of structural mismatch, I think, between what this scheme looks at doing, i.e. we're putting in a convertible loan note, and a lot of the kind of money that has been raised in the past, let's say over the past 5 years, has gone in as ordinary shares. So there's a mismatch between how we want to, and I'm using we, I'm talking about the government here, how the government wants to kind of inject this capital with predetermined conversion rights against the historical funding, which has all been in ordinary shares, and the kind of EIS kind of landscape isn't comfortable with that kind of loan note option right now. So it's not. I don't think it's so much that we're saying we won't co-invest alongside angel schemes, etc. I think it's the angel schemes are saying to us we don't like the terms of this in terms of the kind of convertible kind of status of it. So that one will be ongoing. I mentioned earlier that schemes have been refined, changed, etc. So I'd watch this space in terms of whether there's any kind of relaxation or some other way of getting that kind of point covered. But right now, it's not so much that we're not talking to each other. It's just that we're not aligned in terms of exactly how the investments have gone in. But yeah, I mean, I think going back to the kind of point about innovation, most of the funding that we get involved in is for what we'll call kind of fast growth, high growth, scale up companies on the equity side, and we've got absolutely no reason to change that. I mean, our schemes, which are still there, are still trying to kind of put money into kind of partnerships with other investors. We've announced, even during the kind of COVID crisis, 2 new angel kind of tie-ups, one in Scotland and one down south, and we've committed 25 million of co-investment funding to angel groups. So we're still very keen to see this kind of early stage activity keep going. It's essential, really.
Great, thank you. And yes, you're right. There were a lot of questions around the SEIS linking to the Future Fund. So thank you for answering that. Gemma, yeah.
Yeah, I was just going to say, would it help the way that we would evaluate kind of an earlier stage tech company is, you could go and get a big fancy expert in to charge a big fee to have a look at it. But what we tend to do is we have this thing called the talent network, which is basically about 5,000 names of people that have been CEOs of their own companies. So they've been entrepreneurs themselves. And now what they're looking to do is be non-exec directors and non-exec chairs of growing companies. And typically they're almost like angel investors as well. They like to invest in companies alongside us. So what we tend to do, if we see something and it looks like an interesting space, we will actually get people from that network to go out and spend time with management team and really just ask the right questions, because they will know it better than us, and actually challenge what is this company trying to achieve. And Ollie will correct me here, is no investment is without risk. So the key bit for us is we'll go, okay, this looks an interesting opportunity, but here are the risks, and how do we get comfortable with those risks? And I was going to say, as a broad kind of rule of thumb, if I don't understand the tech and someone's trying to explain it to me and I still can't get it after a couple of times, we probably will struggle to invest. I think being able to articulate what your business does, why it's different, and how it's going to grow is so important. I can't stress that enough. It's got to be very, very clear.
Really great point, Gemma. Thank you. Ollie, would you add anything to that around how investors make the decision around innovative ideas?
I think Gemma pretty much hit the nail on the head, if I'm honest. The worst thing that you can do is make an investor feel stupid by trying to blind them with pure jargon. I always encourage that when you're putting together a pitch deck, if I don't, I mean, and again, Gemma, in fact, anyone on this panel, if I've seen thousands and thousands of pitch decks in my time, both at Fuel and previously as well. And so I've got a pretty good, and both of those investors are sector agnostic investors generally. So I've got a pretty good overview of the investment landscape as a whole, just an overview on the sector base rather than deep diving into specifics. Now, generally what I would say is that if I don't understand your deck, that is your problem and not my problem, because I don't claim to be a sector specific investor. I don't claim to have any specific very sector specific knowledge. And that's really what you have to cater your deck towards. There will be investors that do, and generally when it comes to substantiating those ideas, I mean, we at Fuel are not because we are not a sector specific investor, and generally we stay away from those sectors that generally would need much more substantiation, things like biotech and pharmaceuticals. Generally, we can get a good overview on what the business does and what the business is trying to achieve from a pretty early state. And then what we would do generally is speak to either the investors that are already involved with the business. Generally, if it's an angel investor, and angel investors are really, really important on this aspect. Generally, if it's a sector-specific angel investor, you can get really good insight from them. And generally, what I would also say is that our networks are pretty broad. So if there is any aspect of the business that we don't feel particularly confident about, or we don't feel like we know enough, then we would probably reach out to one of our contacts. I think it's fantastic that BGF has this big network. Unfortunately, we don't have that, but it's great that they do have that. But yeah, generally we would reach out to someone that we knew that knew the sector better than we did, and we would have a conversation with them.
Right, thanks, Simon. Daniel?
Yeah, just chipping from a sector specialism perspective and kind of on debt, as it were. So within our proposition, what we have, so those clients, and this would sit within the Corona Business Interruption Loan Scheme. So, 50,000, not 50,000, but kind of the relationship manager point of contact that we talked about earlier on in the call. So we do have sector specialism. So, we have the agricultural sector, which is very broad. We know that in farming related industries. We've got the healthcare sector. We've got property investors and developers, and then we've got a number of relationship managers who are what we call general trading, so they support a broad range of sectors. But what I would say is typically those relationship managers have been looking after and supporting clients in those sectors and spaces for quite some time. So actually to talk about, yes, keeping it simple, as I would call it, Janet and John information, whether you're going to an investor or someone at the bank, but I think there is an element here that it's really important that you guys on the call have confidence that when you are approaching financial institutions to borrow money, and where there is that dedicated point of contact, they should be able to bring a level of expertise that says, yes, keep it simple, keep it Janet and John, but they should be able to bring some expertise in relation to the sector as well. So I think there's a balance here between sector, understanding the information that you're providing, Janet and John, but also having confidence that some of the people that you're speaking to will have a broad awareness of those sectors anyway.
Completely agree. I would just add to, because I'm aware that I maybe missed it on my point, but what I would just add to my point, completely agree with Daniel. If you are what you would call a tech-heavy, innovative business, generally you would have a pitch deck which is very investor-friendly and very simple and broad, and then you would have a larger plan that goes into more technical specification. That should be something that you have access to, but it's not something you should lead with. So yeah, I totally agree.
Great, thanks guys. I'm just aware that we've got a lot of Q&A coming in. So just two more questions to end with. So the first one is just kind of a quick answer one. There was a lot of questions which we often get at the Accelerator as well around what are the best valuation tools for businesses? And of course there is no kind of one set answer, I'm sure, but does anybody have any kind of thing that a tool that somebody could go look up online, or just where do you start? What's the question? I think Richard is keen to answer that one first. Go ahead, Richard.
Nightmare. Absolute nightmare right now. So whatever the great valuation tools were that existed and that people were using 3 months ago, forget it, chuck them in the bin, start again. So it's interesting that the Future Fund is specifically not valuing businesses, right? The Future Fund is saying we'll value the business next time they do a fundraise. And actually, our own rescue equity fund is doing exactly the same thing. Let's defer, let's kick the can down the road on the valuation problem. Valuation is what somebody is prepared to pay for what you've got. So it's supply and demand. And typically, historically, there's been this kind of unwritten rule that in the early stage, if you're raising the right amount of money for your business at an appropriate stage in its maturity line, then you're probably going to be giving away something in the region of 20% of your business. It might be 15, it might be 25, rule of thumb. Now, I don't think we know if that rule of thumb exists anymore right now. I think it's about much more supply and demand. If there is demand for your business, you may be able to get away with the same valuation as you might have done in February. But if there isn't demand, then take what you can get. It's a market. Markets price assets based on supply and demand. Can't say any more than that, I'm afraid.
Go ahead, Ollie.
Yeah, I've got to follow up on this because I've got very, very strong feelings about this point, especially considering what's been happening in recent months. So generally the trend that we've seen in recent months is we've seen a two-tier trend. And I'm speaking specifically about equity markets, and I'm speaking specifically about seed investors. Now, I've seen two types of trend. I've seen one side which goes towards the, well, public markets are 30% down. So we're going to start valuing businesses, private businesses at seed stage 30% less, or whatever it might be. I've seen businesses take up to a 50% hit on valuations, and that's when term sheets are already issued. These investors are now coming back and saying, we want to slash this valuation by 50%, COVID, blah, 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 whatever. So I've seen that in a couple of cases. I actively think that is a stupid practice. If I'm totally honest, I don't think it's a good practice, and there's a key reason for that. I'd be interested to know Gemma's position on it, because Gemma obviously invests at a later stage, but my position on it is that as a seed investor, I need to be really careful about the level of equity that I am taking within a business. I can't come and take 40 or 50% of that business because I screw the business for a Series A. And the reality is that if I'm going to run, if we're going to have a portfolio of successful venture-backed businesses, the vast majority, if not all of those businesses, will have to raise a Series A at some point. If I come in and take too large of an equity stake within that business, then suddenly later investors come in and say, well, we like the business, but you as a founder don't really have much equity within the business. And that worries us, because it worries us from a point of view of are you motivated? Is it easy for you to move on? Whatever it might be. So my active position is, and we've had companies that we had agreements in place prior to COVID. We had valuations in place. We haven't changed those valuations at all. And I would encourage founders that when it comes to valuations, Richard is completely right. From my point of view, from a seed investor point of view, is that the market is completely supply and demand. Valuation is not based on any key metrics. It's based on the point that you as a company are happy to sell shares, and me as an investor, I'm happy to buy shares, and that's the reality of it. There is no magic bullet or magic formula that will help you. Generally, you would compare against other startup valuations in the space. Be careful when you're comparing against US valuations, because they are sky high, always have been. But generally, you would compare about others in the space. So yeah, agree. It's a complete marketplace. But also, when it comes to equity and when it comes to seed, if you are expecting to raise a Series A, a Series B, whatever it might be, do not sell yourself short and take huge chunks of dilution, because that can really, really screw you for a Series A or a Series B from those investors.
Thank you, Ollie. Would anybody else like to add on the valuation?
I was going to say, Christina, very similar to what Richard and Ollie were saying there. There is no science to this. The way we would value is look at comparable transactions. What type of investment and size of investment have gone into similar companies. We'd look at profit, or we'd look at revenues, depending on the sector. I do believe it is going to be tricky for the next 6 months if people continue to invest, because you're going to have to be very comfortable that a business is going to come through COVID-19, and comfortable what's it going to look like in the next 18 months. And being frank, nobody really knows what the answer to that. But to Ollie's point, yes, we have invested or completed deals during this period and have stuck to our valuations, because we have taken a view. Now, some of that's been driven by the type of businesses we've backed. But I do think it is going to be tricky the next 6 months, what things are going to look like.
Absolutely. Great. Thank you, guys. And just one final question, just to kind of wrap up what we've been talking about before we go into the live Q&A. There was one question about what learnings should we consider from the recession. So from your perspective, and we'll kick off with Ian, but I'm open to all of you. Are there any learnings from the last recession that we should consider for now and going forward?
Probably a huge amount, to be honest. Although I think somebody said earlier, this is a different sort of crisis we're in. We had a financial crisis before, which I think shouldn't have really taken everybody by surprise. You could see it building, but it kind of burst a bubble. This one has come up upon us so quickly that we've had to collectively kind of react in a way that I think that the UK has never really had to do in kind of post-wartime settings. I think for me, companies probably need to build more kind of contingency forward planning into their funding, and that's tough at the moment because of trying to get all the stuff we just talked about, valuations, investor appetite, etc. But when things start to kind of settle down, I think companies need to kind of really look at what they have to have in their kind of locker room, and that's everything from contingency planning for funding, and also kind of business interruption activity. I think anything that kind of looks like it's going to potentially be an issue for them. I'm not saying you can cover everything off, but I think having that kind of forward planning built into your day-to-day life is going to become essential. A lot of the stuff that when we talk to banks at the moment around about how they're getting on with kind of the various different loan schemes, some of the feedback we're getting is that companies have not really been able to put forward convincing cases, and that's partly because of where we are and uncertainty regarding times to get out of this. But it's also partly because they didn't have it to start with, so they were kind of forced to make something up really quickly. And unfortunately for some of the banks, it's not doing it. Like we delegate credit decisions to the individual kind of partner banks, so we don't say to them, you must adhere to the way we want things done. We've got to leave it to the partner banks to decide. But some of the kind of feedback we're getting is that a lot of companies just don't have the armory to come and talk to funders. I think that's a big change going forward. We do a survey every year about the small business finance market, and there's a stubborn number that only 25% of SMEs in the UK actually borrow money. So the ones that haven't been borrowing money, who now have to focus in on actually trying to borrow money, are just not prepared, and they don't really know where to start. So I think there's to be more support available for that sort of company going forward. So that's a big lesson from the last recession. That support never really materialised. It did in pockets, but I think there's to be a more concerted effort now to help companies really be able to kind of talk convincingly about what they want to do going forward. I could probably spend another 20 minutes talking about it, but I'll let others chip in now.
That's perfectly put, Ian. And would anybody else like to add anything on that? Richard?
I think I'd continue one of Ian's points there, which is it's about consequences of consequences. So one of the things that came out of the last recession was not just post-crash what the immediate impact was on liquidity within the banks, but what then happens as a result of that, and what then happens as a result of the result of that. And that's future gazing. It's guesswork to some extent, but it is really down to this question of the validity of what you're trying to achieve in a market which is not going to be quite the same as it was ever. And I think there's a tendency now, we're kind of through maybe hopefully most of the crisis planning. We're into a slightly more stable situation where we're gathering the support that we can do to replan our businesses and take them forward. But there's still in many people's minds an expectation that things are going to get back to normal. And it's very difficult for individuals not to think that, but it's rather dangerous potentially for us to assume that things will get back to something like they were before. And contingency planning, making sure that we've really thought through the consequences of the consequences, I think is the key lesson that we didn't learn very well from the post-crash time, and that hopefully we can do better at this time, as well as generic system improvement while we've got the opportunity to replan and rethink stuff, big picture.
Great, thanks, Richard. And Daniel, you wanted to add something?
Yeah, so I think build on what's been shared already. So I think the big focus for financial institutions, NatWest, RBS, Ulster as an example, was supporting customers with their most urgent needs. And that's been a big theme for the first kind of 6 to 8 weeks of this crisis. We do know that some of the businesses were impacted earlier on simply because of supply chains that might have been overseas in China. I mean, China shut down, I think, a number of ports back end of December, early January. So that would have had an impact for a number of businesses. But I agree that, you know, and someone made the point earlier, which I'd said at the beginning, which is this is not a financial crisis. This is a public health crisis that's then had significant impacts on the economy. And I think as we move forward, I'd like entrepreneurs on the call and businesses to think about, right, okay, so we've supported the urgent needs, or still in the process supporting the urgent needs. What do those needs look like potentially moving forward with a bit of rationale behind it? And then what are those things that, you know, we can do and society can do around bringing that advice and expertise and making sure that we have the correct armory, that if you're coming to us for a funding proposal, that we really understand those components around your future customer, your future supplier, your future competitor, what your future staff requirements could or would look like with that COVID lens that we talked about right at the beginning. No one's going to have a crystal ball. I think everyone acknowledges that. But what we are expecting is that entrepreneurs and people in business to really understand their sector and to really try and understand what are some of the challenges that exist in that sector so they can then pivot and then come out of this the other side. And I think thinking about some of the content we've discussed of what's available, that's what will drive kind of whether, you know, some businesses survive and then thrive the other end, or whether, I think Richard alluded to this, where there's simply some businesses that just can't get that level of support for the reasons we've talked about, and unfortunately they'll cease to exist.
Great, thank you for adding that, Daniel. Really appreciate it. Great, so that's brought us to the end of our pre-submitted questions. We still have about 15 minutes left on the clock, so we will take some questions from the audience live now. So my colleague Sharon is going to pick a question for you guys, and please unmute yourself if you're ready to answer that question. So Sharon, over to you.
Thank you, Christina. Hi, everyone. We've had lots and lots of questions coming through, so a massive thank you to the audience participants for those questions. I'm going to group them so that we're able to answer 4 or 5 in one go. One theme that has been coming up consistently is that many of our audience members feel that there's clear funding routes for tech businesses, however, not so clear for businesses that are in the service sector or perhaps consumer goods. Is there any guidance and support around where do you identify funding routes for sectors that are not tech related, but perhaps either in the service industry or consumer goods industry?
Who's going to kick us off with that one, guys? Richard?
Well, I think a couple of things here. It goes back to the points that we made earlier on in this call about relevance of your business to the market for funding. So if you're an FMCG business, for example, you might very well be a growth business, and there are plenty of angel and VC funds that do early stage branded goods investment. And so that, I think, is the obvious route to go there. Just because you're not tech doesn't mean you're not growth. So I think all of us really have been talking growth rather than tech. So it's about the nature of your business and whether you're the sort of business that grows. Professional services is quite a different matter, because professional services, broad generalization, and I apologize to you if this isn't your case, broad generalization, professional services firms don't scale, because each individual human resource within a professional services firm has a finite amount of revenue that can be attached to that individual resource. So you don't get the sort of growth rates that your average growth investor might need. Therefore, in the current environment, I think you're much more likely to see support coming from the Bounce Back Loan Scheme or CBILS, and it's more likely to be debt focused and less likely to be equity focused. Big generalizations, and apologizing for that generalization.
I think you've put that really well, Richard. You've covered kind of all the bases there. Around tech businesses tend to be the ones that are more scalable in a sense, but obviously, like you said, not generalizing to all. And I think that's very well answered. Sharon, oh sorry, Ian, yes, go ahead.
Just very briefly, and I will keep it brief. We have something called our business finance guide, and also an online tool where on our website companies can go in and I call it play around with this tool, but basically they can put in some basic information around them, what sector they're in, what they're trying to do, and it'll kind of point them towards where different investors and funders are active. So I can send you the links for that afterwards, and you can share that with your kind of cohort. But that's normally not a bad place to start for very general input as to where to go.
That's awesome, Ian. We'll definitely share that with everybody. So I know a lot of people have been asking about follow-up and contacts and all that kind of stuff. So we will certainly contact everyone with a follow-up for those asking. Sharon, over to you for the next question.
Yeah, sure thing. So we've had a couple of questions from our audience around what are our panelists doing and seeing to attract more diverse investments into their portfolio. So historically, we tend to see not very much diversity in the investment world. So are there any particular campaigns or any particular things that the panelists are doing to support diversity in investment?
Yeah, I'll just pop in briefly here. So it's a bit old now. It's almost a year old. But we produced a really good piece of research around about this topic. I think it was kind of May, June time last year. I mean, it was highlighting the historical lack of diversity in some of the kind of investment kind of landscapes, but also kind of pointing out, you know, some of the positive stuff that's going on and where we see it kind of moving going forward. We certainly, when we pick partners, it's a big area of focus for us. So when we look at our kind of investment activities through the VC world, you know, it's becoming an increasingly important area for us to kind of get right. But that report's on our website. It's 86 pages, but there is a handy 2-page infographic which summarizes it. But yeah, a really important piece of work which got a lot of profile when it was launched. And if people want to dig a bit further, it's well worthwhile.
That's good, Daniel. I'm not sure, you probably know a bit more than me, but I'm pretty sure Coots, the private wealth arm of NatWest, and BGF have joined up to sort of launch a fund that is specifically focused more on sort of female entrepreneurs, because we do acknowledge that there could be more. So from our perspective, we are certainly supportive of having more diversity in both new investments and our current portfolio.
Yeah, and to build on what you've just said there, Gemma, absolutely. So we know that there was the Rose Review that talks a big amount around women in business and women in entrepreneurship and kind of that underrepresentation. But one of the pieces of work that we're undertaking at the moment across the organisation, it's been paused for the moment because of the urgent needs that we've talked about earlier on, was looking at what are those barriers for entrepreneurship, not only within certain sectors, but also within society and certain demographics. So there's a piece of work happening in terms of the BAME or BAMI community, people with disabilities, the LGBTQ community. So, you know, this is really important that we understand that where there are similar barriers, let's find ways to overcome those. But where those are subtle nuances that need to be identified and picked up on, let's also understand that to be able to drive that moving forward. Because we know diversity of thought and diversity of business will really drive the UK economy moving forward.
Thank you, Daniel. Richard, did you want to add something? You are muted.
Very, very quick one. I think to directly answer the question, what are we doing? We've built an assessment process and a rating process which is blind from a diversity perspective. So it's designed specifically to ensure equal opportunity to the marketing, to the fundraising marketplace. So that's full stop. And then if you put that into the Rescue Equity Fund, likewise, if the assessment is the only way that you get into the Rescue Equity Fund, same thing. Diversity, diversification, diversity of all kinds. It's about gender, it's about race, it's about background, it's about location, it's about all these different elements. And I missed some out and I apologize. But it's so crucial. And that's what diversification means from the investor perspective, getting a very broad spread of everything. And that's a really strong thing to aim at as an investor, and a very great thing to ensure equality of access to all across the UK.
Brilliant, thank you, Richard. Okay, let's go on to one final question, Sharon. Give us a good one.
Okay, thank you. So we've got a fair few hustlers in the audience, and I love the kind of mini pitches that we're getting for their own business. But one overriding question and theme that we're looking at is, how do you identify the best route of funding? And whether that's equity versus debt, whether crowdfunding is a sensible route when thinking about VC funding. So how do you navigate that funding landscape? That seems to be an overriding question of how do you go about navigating the best funding landscape? I'm just going to add to that. I know the work that we do in the accelerators, one of the things that we always talk about is whatever funding you raise today, please recognize and understand the impact it will have on future rounds and future journeys for your business. But it would be great to hear from our panelists if you have any guidance on this.
Great, thanks, Sharon. So I know we kind of briefly answered that earlier, but is there anything anybody wants to add to that specifically? Daniel?
I think it was covered earlier, to be fair. So it's about control, ability to repay. What are the short, medium, and long-term aspirations of the organisation, and then for you, what's that risk versus reward? So I think that dovetails into the points that were made. Great,
thank you.
I'll elaborate a little bit more, because one part of that was about crowdfunding. So I'll elaborate a little bit more on that. What you've got to remember with crowdfunding is that there's 3 key types of crowdfunding. The one that most people gravitate to is equity crowdfunding. So that's your Crowdcubes and your Seeders types of platforms. Crowdfunding is an incredibly interesting new way to fund your businesses. Generally, what you'll find with crowdfunding, though, is that you've just got to be careful. And the key things that you've got to be careful about with crowdfunding are, 1, do you have significant lead in place? And that becomes a chicken and egg situation, right? Because actually most crowdfunding campaigns that don't have significant lead investment in place are pretty much doomed to fail. You will struggle to get enough from the crowd to reach your minimum targets. The second thing that you've got to keep in mind is, are you a business that is marketable to a crowd? And these generally are retail investors who will be investing. I think it's something along the lines of 80% of these investors will be doing somewhere between £10 and £500. These are not angel investors, these are retail investors. And you need to have a proposition that's attractive to the retail investor. Now, if you're something like a Monzo or a Revolut or a Nutmeg or a craft drinks company, God knows we've seen so many of them, then you're going to have some kind of connection with those retail investors, because you offer them something. You offer them an immediate product, an immediate payback. If you are a B2B services business, deep tech business, pharmaceutical, med tech, it can be a real struggle, because actually it's very hard for retail investors to sign up to what you're doing. They can't validate it. They probably can't empathize with it. They can't use it. And it's hard to pull those people on board. Generally, the most successful campaigns, the crowdfunding campaigns that have been used as sort of these benchmarks, the Monzos, the Revoluts and such, they are user acquisition channels. This is how these companies see them. They see them as user acquisition channels. They do not see them as investment channels. They don't go onto Crowdcube because they're trying to raise a significant amount of money and they think that Crowdcube is the way to do it. They go onto Crowdcube because they want to acquire a huge amount of users who are paying them to be part of their business. And that's what you've got to keep in mind. So when these stats are thrown at you, Monzo funds £1 million in 90 seconds, don't buy into the hype. It's a heavily PR'd industry. It's an industry that backs itself on PR. The amount of money that would have come through the platforms would have been relatively minor. It would have been heavily lead invested. So it's useful. And it can be useful if you are a consumer business, if you can offer something to these people, if you can use them on your platform or use them in your business. But if you're a B2B business or a heavy tech business, generally I would advise to stay away from those sorts of channels.
Thank you so much, Ollie. I think we've even covered crowdfunding now. So we've got all the different funding options for you guys. And we've got only a couple minutes left. So I just want to really quickly wrap up. Thank you to everybody in the audience for attending, and thank you for all of your super engaging questions. They've formed what we've discussed today, so they've been brilliant. The questions that haven't been answered live and the ones you've pre-submitted that haven't been answered, we will use those to figure out how to support businesses better so they haven't gone wasted. So for the audience members on the Accelerator, we will be going deeper into funding options throughout your program. So check in with your acceleration manager. You'll hear a lot of more about various funding events. But to wrap up for everybody, the key things we covered were what funding options are best for you, right? That's come up a lot. And I think going back to what Suzanne said at the beginning around 5 aspects of winning a grant application were really interesting. So I wanted to reiterate those because I actually think they're relevant for all types of funding. So number 1 was have a compelling storyline. Why does your idea have commercial potential? Number 2, grab attention, understand your marketplace so you can breach the gap. 3, have an excellent management team who helps you to, who you can show how they can execute your mission. 4, have very clear innovations and have a look at what your funding organization is actually after. What are they looking for and how do you fit into that? And 5, make sure you look through the criteria. So whether you're going for grant funding, investment funding, or lending, what is the criteria? How do you fit into that? And overall, I think what we've seen is that there is optimism ahead in the funding landscape. There has been that initial shock for a lot of people. However, things are still moving. The money's still there, investments are still being made. But I think some really great points raised there around we can't, entrepreneurs can't always rely on banks and perhaps lenders for money. So kind of going back to how are you going to make your business success, whether it's through funding or not. So huge thank you to all of our panelists. We will be doing a follow-up after this to share with people. But I thought it would be great just to, if you guys can come off mute for a second for those that are still around, just to share either your website or an email address, whether it's general or specific. So for those that are super keen to just get in touch right now, they can do that. So Daniel, go ahead, you go first.
Really straightforward and simple, daniel.macready@natwest.com. I am the only Daniel Macready in the group. And then also www.natwest.com, and that will list and take you directly to the Coronavirus Hub and the broad range of services that we're supporting, both personal and businesses.
Perfect. And Gemma?
Yep, it's www.bgf.co.uk. Very simple. My email is gemma.hamilton@bgf.co.uk.
Thank you. And Ollie?
Yeah, again, very simple. The website is just www.fuel.ventures. There's no .com or .co.uk, where you can see a breakdown of our portfolio and our application process. If you do need to get in contact with me, actually the best route to get in contact with me is probably just LinkedIn. I'm under Ollie Hammond, OLI Hammond, and you'll see me on there. So that's probably the best way to get in contact.
Thanks, Ollie. And Richard?
Capitalpilot.com, richard@capitalpilot.com. Very simple.
Love it. Suzanne?
Thank you. So www.moralitasgroup.com, email suzanne.johnson@moralitasgroup.com. Thank you. It's been great to be part of it today. Thank you.
Thanks, Suzanne. And Ian, how do people find out more about all the different lending options? I presume they will Google British Business Bank, but tell us some more specifics.
Yeah, so on our website, which is www.british-business-bank.co.uk, there's various tabs there about our different programs. One is just basically our programs, and it will give you a drop-down list of all the kind of COVID-related programs that are currently running. And in each of those, you can kind of find out kind of criteria from a borrower's point of view. There's also links to our equity programs, our angel finance programs, and they're all very detailed. There's also, as I said, a link to our business finance guide and our finance hub, which I think are kind of really useful tools for your cohort to look at. My email address isn't straightforward. It's probably one of the longest ones in the world, but it's basically ian.mitchellmore@british-business-bank.co.uk. What I will do is I'll send through a couple of links to you later on, where specifically to go, particularly with the kind of the research into kind of the VC and CMO market.
Perfect. Thank you so much, guys. And for those who aren't aware about the Accelerator, so the NatWest, Royal Bank and Ulster Bank accelerators, we cover a variety of different areas. So we're involved in the Back Her Business scheme, Business Builder, which is for early stage businesses. It's a digital accelerator. Got the accelerators, which is the 12 hubs across the UK, but also functioning digitally. We have a next level program for scaling businesses, and we also have a program for fintechs as well, obviously being a bank. So loads of different things to have a look into. If you just go to natwest.com/accelerator, you will learn about the accelerator programs, and everything else is on our key websites. So thank you very much for attending this webinar, and you'll get a follow-up from us once we've collated